In this session, we will review the features of a group registered retirement savings plan, or group RRSP, as it's more commonly referred to. So let's take a look at these types of plans. Now, you may recall that employers can provide certain types of savings plans. We've talked about a deferred profit sharing plan, which is covered in another segment. But in this segment, we want to look at the features of the group RRSP program that some companies can install for the benefit of their employees. Now, just a couple of points on these employer-provided savings plans. A lot of these do not have the locking in provisions that you have usually in registered pension plans. You may recall that any assets that are accumulating in a registered pension plan for an individual employee, that employee can't really get access to those funds until they are eligible for a retirement income when they retire. And so those funds in registered pension plans are said to be locked in. For deferred profit sharing plans and group RSPs, the locking in provision does not apply. And in addition to that, these types of plans are not governed by provincial or federal pension legislation. And so you don't have to worry about all of the individual provincial rules around different types of pension plans. You do, however, they are subject obviously to the Federal Income Tax Act, but we don't have to worry about pension legislation when discussing or looking at the features of deferred profit sharing plans and group RSP programs. So let's look at the group RSP program in a bit more detail. So what is it? Well, frankly, a group RRSP program is really identical to an individual RRSP. And as you're probably familiar with an RRSP, a Registered Retirement Savings Plan, in Canada, the federal government allows us to contribute a certain amount of money to build our retirement income. And there are rules around that, many more detailed rules that you can follow under the RRSP, the individual RRSP module. But the key point here is that a group RRSP is not something totally different. It's simply an individual RRSP that's offered on a group basis. It's offered as a convenience to employees, and so it's usually offered by the employer. They would say to the employee, you can contribute to an RRSP for yourself in our group RRSP program. And so why would a company put together a group RRSP program? Well, number one, they want to have it as a benefit to their employees. Number two, the primary reason is that these group RRSP programs tend to offer lower investment management fees and lower administration fees than an individual RRSP. So to the employees, it makes sense, if they're going to contribute to an RRSP, to do it through this group RRSP facility. And so what happens is the employer says, your RRSP contributions, we will take them out through payroll deductions. So out of each of your pay, when we run it maybe every 2 weeks, we'll take out your contribution and send it off to the investment manager and give you your tax deduction right at source. So this is a big advantage to an employee in that they don't have to wait until they file their income tax return at by the April 30th of the following year, where they indicate that they have made RSP contributions. And when they file their income tax return, then and only then do they get the tax credit for the contributions to the RRSP. So the advantage on payroll deduction is that they get their RSP deduction right at the time the contribution is made and taken out of each of their bi-weekly or weekly pay. So a big advantage is, say, payroll deduction, and the RSP deduction takes place at source. In addition, as I mentioned before, there are no restrictions on which employees can participate in that program. It's up to the employee. Everybody's eligible. If you'd like to join in, you can. And so you decide whether you want to participate in the group RSP program or not. Now, because the group RSP program is pretty well identical to an individual RRSP, you are still subject to the overall RRSP contribution limits. And for the year 2021, the limit is 18% of your earned income to a maximum of $27,830. And so if you are contributing to the group RRSP at your work, then you have to honor this RRSP contribution limit. So in some situations, maybe you're contributing, say, $200 a month to your group RRSP program at work. If you have any additional contribution room left at the end of the year, you may be able to put in that additional contribution in an individual RRSP. But in any event, the total of your group RRSP and individual RRSP contributions cannot exceed this RRSP contribution limit. So you can't double up simply because you're going to put money in a group RRSP and you're going to put money in an individual RRSP. The total contribution is the same. And in fact, it's the same formula that's used if you were in a contributing to a group pension plan, to a registered pension plan. And so if you're contributing to a registered pension plan, again, the amount of money you put into the registered pension plan also reduces the balance or the money that you can put into your RRSP. So, the basic rule in Canada is that it doesn't matter what RR registered retirement or what retirement savings program you're in, whether it is a registered pension plan, whether it is an RRSP, whether you're participating in a deferred profit sharing plan, everybody's got the same formula, which is the 18% of your earned income up to this maximum of $27,830 that you can contribute to any of those different programs. And so the total contribution to all of the programs you may participate in is the same number. So you can't get more contributions because you're in more plans. We all have the same number that we can contribute. We can choose which plan or plans we want to contribute that money to. So overall limit applies to everyone. Now, contributions to the group RRSP, again, your employee contributions are tax deductible, as I said, at source. And the employer, as part of a benefit program, as part of a way to retain some of the employees, they in fact may say to the employee, we're also going to put in some money for you because it's part of our group benefit program. And it's not mandatory for the employer to contribute like it might be mandatory if you had a registered pension plan, but in a group RRSP, the employer can actually contribute money on behalf of the employee if they wanted to. Again, if the employer contributes any money, it is going to be a taxable benefit to the employee, and those total contribution rules, that formula still applies to both the employer and employee contributions. Now, so this point simply says your personal and group RSP contributions cannot exceed that individual RSP deduction limit I talked about in the previous slide. These monies or these assets that are accumulating in the group RSP they're not locked in. Just as the assets in your individual RSP are not locked in, you can take the money out at any time. Now, obviously, if you do that, it's going to be subject to income tax in the year that you take the money out. And so group RSPs and deferred profit sharing plans are examples of retirement savings programs where you, as a participant in that program, you can actually get access to the money. It's not locked in. So now, with respect to a group RRSP, what is it that I can do with the money that's in there? Well, at any time, I can transfer the money in my group RSP to my personal RSP. Or maybe if I'm ready to retire and start receiving an income, I can take the money in my group RSP and transfer that money into my personal RIF, Registered Retirement Income Fund. I can also take the money out and buy an annuity. So again, what I'm going to do is I may decide I'm retiring. I'm going to buy a series of payments, a monthly income. So I would go to a life insurance company and purchase a life annuity or a term certain annuity with the money from my group RRSP. Or as I said before, if I want the money, I can take it all out in cash in a lump sum. However, in these last two, as an annuity or as cash, as I receive the payments, certainly if I take it out in a lump sum, I'm going to have to pay tax on that money right away. In these two, as I spread it out over my RIF payments or an annuity payments, I will pay my tax as I receive each of those monthly income payments from the annuity or from the RIF. So again, key message here on a group RSP. It is simply an individual type of an RSP, but you are able to contribute at work. They do that through payroll deduction. You get your tax deduction at source, and possibly your employer may also contribute some money to that program on your behalf.